Ladies and gentlemen, we now come to the fourth panel discussion for the day on risk management in ever-increasing uncertainty, navigating the unknown. I am pleased to invite the panelists to the dais. Mr. Rama Mohan Rao Amara, Deputy Managing Director and Chief Risk Officer, State Bank of India. Mr. B.S. Venkatesha, Deputy Managing Director and Chief Risk Officer, NaBFID. Mr. Wim Mitz, Chief Executive Officer, European Banking Federation. Mr. Ravindra Singh Negi, Chief General Manager and Chief Risk Officer, Bank of Baroda. Mr. Sanmoy Chakravarti, Chief Risk Officer, HDFC Bank. And our moderator for this session, Mr. Abhinav Bansal, Managing Director and Partner, BCG. Request Mr. Abhinav Bansal to initiate the discussion. Over to you, sir.
Good evening, everyone. Thank you so much for being so patient through the day. I know it's the fourth panel for the day, and we'll try and make it as interactive as possible. Just to get started, I think my sincere congratulations and thanks to the entire leadership of this function and this event, because we are running 10 minutes ahead of schedule. And that's really good, really commendable, and we'll try and make sure that we finish our panel as well as on time. So to get started for the day, I think as the title says, navigating the unknowns. There are many unknowns that we deal with in our extremely volatile world today, and we don't know what we don't know, right? It's complex. It is difficult to figure out what we are trying to solve for, and that's what we wanted to pose as questions and as deliberations to our panelists today. I'll start with Mr. Rao on the panel. Mr. Rao, climate risk has been one of the top agendas for many risk professionals in the community in India and globally. And there have been many regulatory and compliance-oriented issues around that, right? Where regulators are trying to tell you how to model it, how to think about it, how to be compliant around it, right? But we are also seeing that it is becoming increasingly volatile and unpredictable. What's happening, not just in India, but globally, you know, the temperatures, the flash drought, the flash flood, everything, right? In reality, how close are we to being able to really model what does climate risk mean for our balance sheets and eventually for the business build?
Good afternoon. I hope my voice is audible. Yeah.
No,
thank you.
Not at the back.
So, good afternoon, everyone. And thank you, Abhinav, for perhaps highlighting a very, very contemporary question, not from the point of view of a very high temperature that is prevailing in the Indian politics today, more from a climate in inverted quotes. I mean, given the kind of vagaries of extreme weather events, the way it is impacting the real economies, I think definitely climate risk is something one has to take cognizance of. And I am very happy there is a lot of sensitivity among all the stakeholders, whether it is governments or whether it is regulators or whether it is the industry, they are grappling with it. But I think looking at India, we are in a very, very unique position. I think in terms of vulnerability, we are also one of the countries with highest vulnerabilities, given the kind of long coastline and expanse of the country. We are exposed to a lot of vulnerabilities. But at the same time, I think government also has a responsibility of balancing whatever approach they take with the interest of the population, with the interest of the economy as well. So I think government of India has adopted a very pragmatic approach. They came out with NDCs purely aligned to this approach in terms of articulating like in every year, whatever power they produce, 50% of it will come from renewable energy. And they have a target of reaching 500 gigawatts of renewable energy by 2030. And they want to reduce the carbon emissions or CO2 emissions as compared to 1990 by 45% by 2030. I mean, these are all taking into account the practical considerations. Why I talked about Government of India is I think regulators have also taken a cue from the same approach. Unlike other geographies, particularly Europe, etc., where I think there are already regulations or on the anvil or they're at a draft stage, I think in India, RBI has adopted a very, very pragmatic approach. They encourage the regulatory entities like large banks to study the best practices elsewhere, to adopt and to start making some baby steps in terms of grappling with this risk, understanding the risk. They very recently came out with the draft guidelines on disclosures, climate risk related disclosures. These are modeled more on that task force on climate related financial disclosures, emphasizing on 4 pillars, essentially the governance. They want the banks to beef up the governance, creating appropriate climate risk management committees, creating a kind of reporting structure, and of course, getting the direction and getting a kind of mind space of the board as well in terms of climate risk. Of course, the second aspect is a strategy, risk management, as well as metrics and disclosure. I think banks, if I look at, how we approached and how other large banks have approached, essentially they started a couple of years back with developing a kind of ESG scorecards, where for a corporate exposures, because better data is available for a corporate and their engagement is also better, they are able to, they're assessing the ESG exposure of a corporate. Particularly whenever the corporate is operating in a red industry, they have come out with a kind of rating. Next stage, of course, is like to truly model the kind of climate risk, you need enormous data. You need a very, very comprehensive data of so many years, because typically the weather events are long-term in nature. In the absence of the data and in the absence of granular information about the counterparties and the corporates, I think banks have started again here making certain assumptions and trying to get a kind of exposure based on the sectoral exposure. Using some metrics, some frameworks are already in place. Some fintechs are already in the fray, helping the banks in terms of getting an approximate idea. They call it as something like a level 5 kind of data, in terms of using a very, very macro level kind of data and coming out with emissions. I think the next stage for the banks, of course, would be to create these climate risk assessment models in a more robust way, which definitely will involve more engagement with corporates, because the sensitivity has to start from the corporates and the industry as well. Create a kind of IT systems to capture the data, historical data, consume or have the capability to consume such kind of big data using AI and ML. I think this will take a few years. And of course, next they will have to think about, once they have a kind of ability to measure, assess, then it is more like integrating into a traditional risk framework, where we start looking at like what are our policies with regard to these red industries, or what kind of concentration limits we want to have. And perhaps the larger question is, should we price the risk and when to price the risk, all these things. But I think that is at a very, very later stage. I don't think we are at that stage as of now. But definitely, to sum it up, I can say like this is engaging the attention of everyone, particularly at the board level.
So fully agree and very well articulated. I think as long as we can get the right data, then of course the tools exist, and we have been modeling many such kinds of data even in the past, right? So, but you're right, the things are changing fast, and in that context, we don't have enough data from the past to be able to predict what it will look like. Wim, to that extent, what have you seen in Europe and North America? Do we see the same data struggle, or we have something more under the sleeves which can be useful?
Thank you very much, and it's great to be here, because I think that the risk management function is one of the core parts of banking and one of the most fascinating, because as we all know, trying to get the unknown knowns on our radar screen, many of you risk managers have to deal with the unknown unknowns. So that goes quite far, and many of the issues are similar and slightly different. So I indeed will, if you allow me, say a few words about the approach in Europe to cyber, data and IT risk, but also climate and ESG risk, and also a little bit look at how after the pandemic, the risk managers came together to deal with the possibility of NPLs. But first, indeed, I think that one of the, if you saw, and this is written in the preparatory paper, if you saw that the global financial crisis was really a crisis of excesses. So we should have known. We didn't, but we should have. And if you look at the new risks that are emerging now, then you see that this is a change in technology, a change in environment that we need to deal. So it becomes much harder to deal with it. At the same time, and this is, I think, a difference, I guess a difference with Europe, is after the financial crisis, after the pandemic, we've seen that European society as a whole has a much lower risk appetite. Society cannot deal with risk anymore. And that leads to an effect in the way regulators and supervisors look at risk, and consequently how we look at it in a bank. And certainly if you look at the importance and the risks, the cyber risks, I want to illustrate this a little bit. Because if you take the digitalization of our society and certainly of banking, we try to make a cartoon to catch in one picture what the risks are and how our regulators and supervisors are reacting to that. And I would argue that with that they create a regulatory risk. But if I can show, if you can show the little cartoon that I had made, which reflects, in my view, the regulatory reaction. Here you see it. So here you see the risks. We have, of course, in digitalization, we have to deal with geopolitics and fraud, supply. We have lack of cyber skills among our population. All of this was already said. But then the whole thing, the level playing field, and here is how European regulators have reacted to that. They've done many good things, but I would argue they've done a lot of them, and they are not always consistent. And this in itself will create new risks, and that is the discussion that we have. So if you look at indeed at the outsourcing to the cloud, which creates a new risk environment, but also a new role for risk managers, I believe that there is good legislation, but it is also complex and it creates mistakes. It possibly creates mistakes. The other part is, for instance, that the European Central Bank is adamant that it wants to bring a retail CBDC, a digital euro. And I fully understand, but here is indeed where it's so important that risk managements are involved at every stage of this test process, because I would argue that it makes absolute sense that all central banks work on a CBDC in an experimental or an actual phase or in a pilot phase, except that the European Central Bank is unique in the world that it wants to start with a retail digital euro. So it first wants to go to retail, it wants to roll out immediately, and it wants to add a free 3,000 euro wallet and a payment system. I would argue that with that you have actually created a retail bank, and that leads to risk that needs to be in the market that needs to be dealt with. The same with cybersecurity. Ransomware attacks, I would say, on the top of the list in what we do. And one thing that I think that keeps us awake every night, so that is a very known, it's not if, but it is when, is if you look at the ransomware attacks we've seen, mostly even if you pay immediately, it takes 13 to 15 days to become operational again. In Europe, we've stress tested what would happen if your liquidity sensitive parts of the bank are hit, like your treasury, where you have liquidity for 2 days, but it will, even if you pay, it will take 10 days. Now this is for me one of the big things. Now quickly moving on to climate risk and ESG, I think we are on the right road. There is a close cooperation and there is a clear commitment to go to net zero, but also then to building the house of reporting, managing the risk. But there, if I would argue, underlying, if you look, we have on Thursday new elections for the European Parliament, and the general idea is that will move to the right. And here we introduce a political risk due to fragmentation. In my view, that is also one of the worrying things we have to look at, because it will only work, and this is going straight to the risk management function, all the investments that we have to do require long-time political commitment. If we want to go to solar, if we want to go to wind, if we want to go to electric mobility, all of this requires long-term commitment, and it is the political risk introduced that may make the investment case completely different. I'll stop here. As you know, I am absolutely enthusiastic about this panel, so I can go on for hours. But this is the situation in Europe as a whole.
Yeah. No, so if I could just ask one more question there.
Yes,
I think we talked about the legislation aspect of the situation around climate risk that I understand, and you also talked about the overall appetite for risk post the crisis, and the things that are happening all across Europe, and hence there is a certain risk appetite that exists. But just from the perspective of banks' own individual capabilities on being able to model climate risk, do we see more data in Europe? Do we see more granular tracking in Europe, which allows you to do that kind of modeling? Leave aside the legislation aspect of it, the point that Mr. Rao was making in Indian context.
Yes, that's a very clear question. I have a very clear answer. As my colleague Eelco Dubbeling already said, for the Netherlands, they're building the data warehouse that is needed. And in Europe, we are in we have a project with the ECB, because it's a little bit of a chicken and egg problem, as you would say. The problem is that the ECB says that we have to report climate risk, and we say our clients don't even have the data. So the way we solve that is by setting up a project team to really try to build the data as fast as we can. And they will not be perfect, but it is clearly a commitment to move forward on that.
Yeah, understood. No, thank you very much. So, Sanwai, a question to you. Wim talked about, the first half of his conversation was actually about cyber and things around IT risk and so on and so forth. In my mind, that's also a big unknown, from the perspective of the level of sophistication that we see in some of these cyber attacks. It's just going through the roof. And the cost to launch such attacks, and the cost of banks especially being vulnerable to such attacks, and the whole technology risk in itself is huge, right? How do we keep pace with such sophistication on cyber and IT risk? And what role should the office of CRO play, given that there is also a CISO and then there is a whole technology team around it? How do different functions come together?
Thanks, Abhinav. It is easy to question, very difficult to answer, because whatever answer I shall give, in the night we all, at least I, become very paranoid, saying that God knows what kind of cyber attack is happening to the bank at this point of time. And whatever we say, whatever tools we deploy, we all know that the hackers are probably at least one step ahead, maybe more than one step ahead to us at this point. So, I shall just divide it into 2-3 parts, your answer. One is specifically on the cyber, which probably is a risk which banks, every financial institute has started internalizing for quite some time at this point of time. Have we been able to do enough? Never enough, but we are doing. What I also think about is that look to the previous session we had, which was on a fintech. It is a big thing. Most of the banks are vigorously getting into the technology solutions as much as possible. How much in the risk management department we are thinking about technology from the deployment perspective, that what kind of risk is being taken? I am not only talking cyber. Cyber is one risk, definitely, that is in most of the places probably CISO already reports to CRO, and there is some understanding is there. But are we looking properly into the technology risk per se? We talked about in the previous session, there was a discussion about cloud. Yes, people are moving to cloud. What kind of risk we are creating by moving into cloud? This is some of the risk which is understandable, but at the same time, at the risk management function, I can only talk about in general. I'm not talking about any specific bank. Probably in this country, we are not looking into it holistically at this point of time. We do look into outsourcing because RBI asked us to do so. But outsourcing, one part is that what is the vendor, another part is that what is the technology solution that the vendor is providing, what kind of risk you are creating because of the cloud, because of the API, and because of any other item that you are looking for. Can't blame us completely. One of the things probably is happening is that generally speaking, we are all coming from a background which is not a technology background. Most of the risk management function people are credit risk guys, have done general banking activities. Maybe some of us, I am one of them, is from the treasury background. None of us are technology background people. So immediately we have the mental block saying that this is technology we don't understand, CTO will understand, CIO will take care of this problem, it is not my problem. But this is not going to go away. This is a risk which is probably one of the central risks right now which is running. So it is only imperative that we look into it in more and more detail going forward. Probably it is one of our central role at this point of time. One of the central role. I am not saying that this is the central role, and we need to acknowledge that. That is one part. Although you did not ask me the question, but still let me take the liberty to go one step further. Again, I was just sitting and I was hearing the previous panel discussion. A lot of discussion was happening, very rightly so, about AI, ML, about doing large data analytics. Again, we should probably question ourselves. From the risk management side, are we validating these models? What exactly, who is looking into these models? Now, quite a lot of these models are going now and facing the customer.
Yes.
And when a model is facing the customer and very quickly all the banks are moving to an STP channel for all these customer facing models. If we are doing an STP based on a new analytics, I leave my judgment whether it is an AI or ML or not, but any new analytics. From the risk management side, what kind of oversight we are putting into this? Again, the question comes that how much expertise is there right now in the risk management? If it is not there, we need to build it up. This is in both the situation technology. First one is a direct technology risk. Second one is that ancillary risk that comes out of using technology as a platform in the bank as a whole. Both of them need to be looked at. I would be happy to tell you that exactly what is the prescription and how to do it. Unfortunately, I can't tell you. Only thing I can tell you that as a CRO, it is our job to make sure that we are looking into this. We are not shying away from this, saying that this is not an area we understand.
But that's a good step one, right? I think just the acknowledging the fact that it is complex, the fact that you are losing sleep over it. I think the shareholders can then sleep peacefully, right? So that's a good step one.
Maybe if you allow me to supplement what Samay has said, Samay's response has been comprehensive. I think the dependency on the vendor is given in IT field. I mean, we can hardly wish it away. I think whether we have enough resources on the bank side to supervise or oversee the work, of course, engaging the right type of people on the bank side, which is also an extremely difficult job. Second thing is like a vendor management or having an oversight on the vendors. We have seen some kind of incidents like how a change management process can be over leveraged or otherwise a fraudulent vendor's employee can simply play havoc in the system we have seen in the recent banking history. I think having checks and balances, controls around the change management process, and having a very robust SLAs in the contracts with the vendors and enforcing them. It's very easy to say enforce them, but we also know the situation when we backtrack. But I think at least we should appear like we have the strength to demand a kind of enforcement of SLA. I think while the cyber piece is one part, second thing is dealing with the vendors who are providing the solutions and services is also another part.
So I think Mr. Rao has raised a very good point, and that is definitely for us to all introspect. One of the problem I face, and good to hear from anybody have any thought process on that. The moment, see, when you are looking for a non-IT vendor, if I'm talking about a vendor, and if you are looking for a non-IT vendor, okay, you may like to be able to, or you may be able to change this vendor relatively easily going forward if they do not follow your SLA. The moment you are in an IT vendor situation for a local bank, most of the local banks, it is not so easy to change them. You are already connected with them. It is not going to be easy. So doing a pre-check is much more important. It becomes very important to check before you are getting into a contract. Once you are inside the contract, it sometimes becomes very difficult. Now, here is the dilemma. Problem is, most of the cases you will go and check beforehand for an IT vendor, and if it is a fintech, by definition, you have to take a leap of faith. Because you know what, they are not the largest companies in the world. So you are taking a calculated risk at this point of time. But the moment you are taking a risk, whether better be calculated and better be looked by the CR. This is what I think Mr. Rao is also trying to talk about. That we need to look into this very carefully, and we need to look into this. Because once we are there, we are there for good, at least for the next 2 years.
So points well made. Points well made. I think Sanmoy in between said that if there are any feedback, questions, clarification, please feel free to participate through the conversation. It doesn't need to wait till the end. But coming back, Mr. Negi, I think we have talked about a lot of issues from climate to cyber to IT risk. In the cartoon that Wim showed, at the bottom of that ship, there was operational resilience, and right at the bottom. I don't know if it was intentional or if it was just by design or fluke, but the fact is, even in the Indian banking ecosystem, we have seen multiple instances of operational resilience being called out now as an important feature to look at. And it is again one of those things which we are not probably wired naturally, because we think about credit risk, market risk, liquidity, and so on and so forth. But this is something which is new. So how do you think about it?
Yeah, thanks, Abhinav, and thanks IBA for having me here. The first, actually, I was actually going to start my conversation with that risk management is art and science, and I mean, you have proved it. I mean, you have a wonderful drawing there. And then again, we are surprised to see at the bottom operational resilience, and in fact, it is the bottom line. And I mean, it's very carefully crafted cartoon. I think that deserves a big kudos. So we come back to the topic of operational resilience. So we have heard Mr. Rao saying about the climate impact and that kind of like modeling and all. But one of the issues, see, whatever models we bring and whatever way we quantify it, but what we do with the already released carbon stock in the atmosphere, I mean, that is going to cause the disturbance, and that is already having disturbances. And if you see across like India, we are talking about heat waves, and many of the people actually have died due to the heat waves and all, and it's extremely challenging to stay out during the daytime. And day for yesterday also, I was actually just reading the newspaper, and then one article says it has impact on the collection efficiency. I mean, you are not able to collect. So a lot of collection actually happens through the physical medium when you actually visit the borrower, so it impacts it. And once you are not out in the open to construct buildings and to do so many things, I mean, then it also impacts the economy. And then it also goes to the kind of like, you might have seen the last monetary policy committee and the document of the RBI, and last 2-3 documents actually mentioning the climate risk. So it is being embedded into the financial system. So this brings a challenge. So once any event happens, how prepared we are, as Sanmay said, I mean, we are not that, how skilled we are actually as a risk managers. Are we purely kind of tech people who can actually look into those aspects? And as you see the DORA unfolding in the Europe and the guidelines, I mean, particularly they focus on the topics which we have been discussing about the ICT and cyber security risk or the third party risk management. So these actually came out to be the crux of the DORA, where this lies, and this is the crux of the entire operational resilience part of it. If you go to it, 70-80% part of the operational resilience will be these only 2 parts. Now, one is outsourcing something, and then again your vendor outsources it to somebody else, and then he outsources somebody else. So are we careful enough to actually analyze those risks, and are we doing it? As Sanmay said and Mr. Rao said, before entering into a contract, what sort of clauses should be there and who should be responsible? So we are resilient as long as all the channels are resilient, all the dots are who are connected in the system, they are resilient. So for example, in December 21, we have seen the Log4j the security threat vulnerability, and who would have imagined that such a small kind of thing can become an international cry, and means we'll all think about it, how it can hit us. So a small flaw in the entire chain, entire dot, even in the financial system, can badly hit all the players, and then comes into the picture operational resilience. So it's not that we have not been doing it, the banks have been doing it in the bits and pieces. So for example, somebody might be responsible for the business continuity planning, BCP, as you say. Somebody is responsible for the ICT and cyber security. Somebody is responsible for the operational risk management, and somebody is responsible for the outsourcing risk management. So different banks, different guidelines, different people actually looking into it, but who is looking holistically actually into it? And then comes operational resilience. Can we actually bring all pieces together and connect them? So they might be, the objective might be slightly different, but they are hugely interconnected and there are interdependencies. So again, these two terms, they become very, very critical as far as operational resilience is concerned. Interconnectedness and interdependencies. And then it leads to us mapping each and every service and probably most critical services, as I say. So you need to identify the most critical services on which actually your continuity will be challenged, or you will become a challenge for the financial system. So can we map end to end? Can we map people? Can we map process? Can we map technology? And this might sit not only within India, but this might be for a global bank sitting somewhere else. So for example, some global bank running a global capability center in India. So what if? So they need to actually map entire thing and look at the entire chain. And at times, it might be a very small part of the chain, but it cannot be taken for granted because the entire operational resilience will be as strong as the weakest link in the chain. So that is all about operational resilience. And that was truly the bottom line. And that is the true bottom line actually.
I fully agree. I think the multiple points that you made, Mr. Negi, around interconnectedness, around being adaptable, around the fact that we can do some kind of 80-20 to prioritize, and then also the fact that within that 80-20, once you get into that 80, being comprehensive, overwhelmingly going into the details, and it is a lot. I fully agree and appreciate that, and that's the reason why it is not yet fully understood to that extent and appreciated. But Mr. Venkatesh, coming to you, look, I think one aspect of risk is also being adaptable to whatever we get as a guidance from regulators in the land, right? Just from your experience, and given that you deal in infrastructure finance quite a bit, we had a very recent guidelines on project finance, right, from the regulator. How do you foresee different shareholders or different people in that ecosystem being impacted by such kind of a guideline, and how do you deal with that, from adaptability perspective? Because there is a running business, all of a sudden something comes like this. So how do you change your track?
Thank you. So this, I think we need to put it in the category of known and unknown. So that we know the regulators are always working on something or the other. The regulations keep coming. But what we do not know is what is there in this store. So this is one such circular which the Reserve Bank of India has issued the draft guidelines. Of course, this is still in discussion. So a lot of discussions are going around that. So the different stakeholders, the first stakeholder is the regulator himself. So what exactly they are looking at this particular area of lending, the project finance, and what are the risks they are looking at from their lens. If you look at somewhere, the credit growth is going very high. So even in the project finance sector, most particularly if we study the infrastructure lending, the NBFCs form almost 55% of the total lending, and the banks have got around 45% share. The NBFC's growth in infrastructure lending is almost 14.5% in the last year. So that is the level of growth which is happening in the project financing. And banks, despite corporate lending is not growing so big, but in the infrastructure lending, it is growing at a rate of 6%. So there has been a kind of exuberance in the credit lending, which the regulator would like to moderate. So that is one point which we can look at. The second point, which the right pricing of the risk. So that is another area where we are looking at. So most of the project finance are not getting the pricing which they have supposed to be charged. So 15-20 years of loans with 6-7 years of construction, and knowing very well the developer is very weak, but still the pricing is not completely embedded in the transaction. So very loose pricing, which is again a cause of concern for the regulator, because if it is not done, then you are not building the reserves to take care during the 90 days. So that is another area of concern which the regulator has seen. The third one is the counter-cyclical measure. So now the position is that all the banks put together, it is 3 lakh crore plus profit which has been generated this year. So this is the right time to implement such things where they can put the counter-cyclical buffers. Instead of putting the entire CCB, they have come with one particular measure in the segment which is most impacted. So this is where you need to build the reserves so that you can take care of the requirement in the difficult times. So the banks are at a great position to observe these kind of reserves which they can create. That is another angle to it. And the last angle which we are looking at is the ECL thing. As per the India AS, the banks have to move. So ultimately, when India is implemented, the cost of provisioning will be very high. So it is a one step towards that. So that means you are making the banks to prepare for adopting the India's guidelines. And historically, even the ECL part, the expected credit loss for all infrastructure lending, if you take 10 years data, PD and LGD data, it is very huge. So that is also the point where the regulator is coming from. But if at the same time, if you shift the reference point, instead of taking 10 years, if you take it from 2019 onwards, the PD LGD data falls drastically. That is clearly demonstrating the structural reforms which have undergone in the country in terms of concession agreements which give a lot of strength to the lenders to lend and the strong counterparties and the resolution mechanism through IBC. So all these things have really improved the system, and the collection mechanism also has improved through the discoms have now more discipline in their making payments. So lot of developments. So absolutely the slippages are very less. So considering that, whether really it needs to be triggered at this juncture, looking at the improved financial position. So this is from the regulator's point of view. So that's where they are coming from. If you look at the lenders, bankers, definitely yes, it is going to hit their CET1 ratio straight away. So that kind of provisioning will make them to, at least if everything is implemented and at a good position at the end of 5th year, so the CET1 can go down by 3 to 4% also. That is the level of impact it can create. So now the banks have to build that reserve. So that can happen only through passing the price. So that pass through the amount what they have to recover through the customers. If that happens, then there is a increase in the project cost and the viability of the projects come to a question. So that is the impact which it is going to happen. And from the developer point of view, obviously yes, the project costs are going to go up considering the impact of this circular. And the second one is most aggressive bidders and the non-serious players who are actually the reasons. In a way, they are also the causing concern. If you see some of the HAM projects which are considered to be very safe, the project cost which they are bidding is discount to the bid project cost, which NHA is projecting as the project cost. So much of steep discount, which is making them unviable, the projects. So in the midway, the people are leaving the projects and a lot of termination clauses have been implemented and substitution has taken place. So it is impacting as a systemic risk it is creating. Once the infrastructure is not getting created, the bank funds are locked in long-term assets and asset is not generating any income. So that kind of situation they want to eliminate. So the non-serious players will definitely get eliminated. Only serious players who are really into business and who are able to demonstrate good project skills will remain. So it is overall, it is a balance between the growth and the financial stability. So that fine balancing which it has to be done. So it has got a lot of implications. At the same time, growth also should not get impacted. So considering that, definitely a balancing view will come out. So all the stakeholders are providing the views. So hopefully we expect a better resolution in this regard.
No, fully aligned. I think, as you rightly talked about, all the three perspectives, and yes, there is always a balancing act between, what regulator is thinking about, how lenders are thinking about, and then the borrower, and then maybe even the end goal of the economic growth itself, right? So all of these are to be balanced, and you rightly said it's a balance between growth and exuberant growth, maybe to that extent. Mr. Rao, I'll ask a bit more, just taking cue from what Mr. Venkatesh said, more philosophical point. We talked about so many risks and we didn't talk about many other kind of risks, that we deal with in a banking ecosystem. We can contain many of these if we were to set up robust risk guidelines, right? But then the question is there a trade-off when you go down that path? A trade-off against the growth or the profitability? Are you sacrificing some part of it? The question one is there really a trade-off, right? And if there is, then how do you balance that? Because yes, there are expectations from employees, customers, shareholders, everybody is expecting something, right? How do you deliver on those aspects?
Yeah. I think first of all, this question of whether putting some risk guardrails in an institution around the business, what they can do, what they cannot do, need not be conceived as a kind of obstacle or anything. That's all like a misplaced concern, I will say. But at the same time, the rails have to be robust. I mean, a lot goes into the design. I mean, how they have been designed, right? I mean, are they meant just like is risk simply acting as a go, no go, oblivious to what's happening on the ground or what's happening in the ecosystem? So a lot goes into how you design the guardrails. But on the other side, should we do away with guardrails and give the freedom to the business? I think all of us are sensitive enough. And Wim has also alluded to the kind of excesses that happened in global financial crisis. And we talked about, I mean, the recent experience of even banks failing in US last year. I think we hardly can actually make the risk as less conservative or anything. But the bonus on the from the governance point of view, the bonus is on the board to ensure like the guardrails are put in the right way. That essentially means they need to help in terms of what lines of business they want to pursue, and they have to clearly articulate the risk appetite. First of all, before that, they need to even appreciate what is the risk capacity of the institution. So, risk appetite squarely falls within the ambit of the board. And the risk appetite, which is typically defined in terms of maybe a capital adequacy ratio, having a buffer, something or some additional buffer over and above the regulatory minimum, and some kind of risk-adjusted return, etc. If it is articulated at a very, very high level, at an institution level, I think down under at a BU level or at a product level, they may be at loss to understand how to implement it. So the appetite has to be cascaded at BU level and even at the product level to serve as a kind of guiding post. And then, of course, you have I think, particularly thanks to RBI, which has been emphasizing on very robust kind of governance and risk management in all the banks, NBFCs, and even urban cooperative banks, etc. This concept of risk-adjusted return has well set in all the institutions. So every proposal, when it is examined at a micro level, the inherent risk is compared vis-a-vis the return that is proposed. And there is a kind of threshold for each institution based on their comfort and appetite. So that way it's being ensured, at least at a corporate level, a corporate loan kind of portfolio. But of course, when it comes to retail, it's a different ballgame altogether. Most of it is commoditized. So you cannot be charging a completely different rate than what the industry is charging. So there the limitations are there. But at least in corporate finance and to the point of Venkatesha, in project finance, etc., definitely we can look at a kind of right pricing. I think risk also has a kind of responsibility. The responsibility, as I said, first of all, the risk management itself has to be integrated into the strategic thinking. I think even RBI also encourages alignment between the risk appetite, stress testing the business plan for the next 12 months and 3 years, whether it actually is within the risk capacity of the bank or not. Such kind of good principles are there. And of course, the risk also has to focus on creating the awareness itself. While there are always some cardinal principles and guidelines are there, ultimately, if you make the frontline risk aware, and if they own the risk and if they understand the risk, that is a success for the institution.
I think you articulated it really, really well. You know, the whole story starts at risk appetite statement, right? And as you articulated, it is not an individual function which is deciding the risk appetite statement. It is the board collectively taking the decision, cascading it to BU, then BU cascading it to product. But unfortunately, sir, it doesn't happen so often as you would wish it to, right?
May I add something? I think Mr. Rao beautifully talked about the risk appetite statement. One problem I have seen some of the places comes out is that risk appetite statement takes care of the credit risk, market risk, quantifiable risk. One can figure it out. When you come to non-quantifiable risk, or quantifiable but not directly quantifiable with a specific product, that is where sometimes things get a little problematic because you are not being able to express it properly, right? Because it becomes a subjective judgment between my judgment and your judgment, right? And that is where probably the CRO and the overall risk management department's standing, stature, its the board agreeing and believing in the trusting the risk management becomes very important, because that is the place where we cannot show that, okay, you know, risk-based pricing wise, I am getting this number and therefore this is the correct number. that is a quantifiable area, I can do that. Non-quantifiable, I can't. So that is the one issue.
So fully aligned. And I think the broader theme I really like, how you articulated that the trade-off can be actually more in sync once the organization is put together and everybody is on the same page. When you in the first round of questions, you talked about that in general the risk appetite is going down in Europe, right, for whatever reasons. And then on the other hand, from whatever we read and understand, the economic activity is also at a slightly lower levels, and the GDP growth that you would want to expect is not there. Economies are still trying to come out of the crisis. So, do you see these at loggerheads, or do you see, as Mr. Rao explained, it doesn't need to be, right? The risk guardrails can very well help you drive the growth objectives in the economy. What's your sense from European banking ecosystem perspective?
That's again a very good question, and I need to get my crystal ball for that a little bit. But if you look indeed, which is very sharp analysis, indeed with risk appetite going down and banks' income through to negative interest rates for a long time relatively low. Now there are some positives. The first one is if you look at COVID, where I would feel that the reaction of European governments was the right one by massively supporting business through the banking system. And again, that was a little bit of a watershed moment, because post-COVID, we were worried that because of the massive support, there was no hygiene in the market. So we would not be able to measure the good companies from the bad companies. So one of the things that we did is, because every country, and that's in Europe, had different ways of dealing with possible post-COVID NPLs, we put all of the risk managers, 40 risk managers together to exchange best practices. And the general understanding, and that's my optimism, was that the fallout was very, very limited. So that's the first good thing. Secondly, we saw that interest rates have now gone to normal. So this margin. Having said that, the overall risk appetite, and again, if you look at the way society looks at banking and looks at banking in Europe, that the level of capital regulation, but also resolution costs are relatively high. So the cost of banking in Europe is relatively high. So in my view, the next European Commission will have to have a hard look exactly at the question that you ask. Where is the balance between healthy banking opportunities? Because now we know we're safe. We did this little stress test with Credit Suisse at our borders last year, and we know that we are safe and resilient. But now we have to go profitable, which is a complaint that many people in the world have about European banks. So you see that balance is off. Banks will say, our regulators and supervisors will have to have a hard look at the cost and choices in regulation without compromising capital levels. I think that was a big lesson from the crisis. But looking more in the supervisory and reporting practices, and we will need to enable banks to go into new ventures. So the entrepreneurship needs to be back. I'm an optimist, but it's not good right now. There needs to be more needs to be done. So that's a nice task for the next European Commission.
No, fair point.
And I sent them this cartoon already, obviously.
No, sounds good. So yeah, I think there are multiple avenues of how you think about balancing the whole growth and risk aspect. And I'll come back to what Mr. Rao said. As long as we can get some level of alignment, risk appetite statement is one way of doing it, and there could be many other platforms and forums of doing that, but that is required to be really able to put the sync around trade-off. Mr. Venkatesh, throughout the conversation, we talked about many different types of risk and everything, right? But one thing is also emerging is that while there is so much volatility and so much unknown that we talked about, there is also a lot of data and analytical tools which are getting built up, right? And in the beginning, we also talked about when Mr. Rao said that in some places, in some use cases, the data is probably not as rich as we would want. But in other cases, maybe it is, right? Are we as a banking ecosystem really leveraging the power of data and analytics? How far are you?
Thank you. See, data has always been called as the new oil, so which is the important decision-making tool. So now the data-driven decision-making has become the popular clause in the banking sector as well as in most of the government sector also. The decisions are completely driven by data. So last week I was sitting with the Department of Economic Affairs where this PM Gati Shakti is being rolled out. So of course it is available for only government agencies. So they were demonstrating how exactly they are doing it. So it is purely data-driven decision making. So any project which is above 500 crore has to be necessarily run through PM Gati Shakti tool. So there it goes. It is sitting with the entire data of the country with regard to the forest area coming in, what are the parallel lines which are coming in, everything. So whatever the design which the departments have come will undergo a tremendous change when it comes to PM Gati Shakti. It is completely data-driven and artificial intelligence which is working on it. It gives more efficient pathway and it gives more efficient designing for the infrastructure which they are going to build and reduces the cost and protects the environment. So that is the level of data integration which has happened at the ministry level. But government can do it. So why not the financial institutions? And that's how the question comes, because that is something which is never expected from the government to work so proactively and integrate the data and take decisions of some of the important projects of the country. So I was really astonished to look at it. So that is the power of data. So whether we have that kind of data within the banking system. So now what is happening is we are very fascinated by the hollow the core concept. So where everybody is moving out of the core activity and trying to build several layers and modules. It is very good because dependency on the core reduces, but are we really able to integrate the data which is being built across each module? Is there any repetition of the data which is happening? So ultimately the data has to be fit for purpose. It should not be something, the quality of the data is utmost important for taking any decision. If the accuracy and completeness is not there and there is no purpose why the data is sitting and the purpose of the data vanishes after 6 months or 1 year. So are we updating the data? So these are the controls which are required to be built. So that's why the data management itself is a very big function in the banking system which none of the banks have taken steps to build this kind of architecture within the institution. So it is not only here, even the 2007-8 crisis of financial crisis, the clear recommendations from BCBS is to have the risk data aggregation. So because during that period, the counterparty exposure, nobody had a clue what is the kind of exposure they have on some of the counterparties. That is the level of data missing, which really created that kind of crisis. So despite 2007-8 guidelines, banks are still in the process of building that, and that has not taken shape. So as recently as European Union, European Central Bank has issued guidelines in March 2024 to have a robust data management framework within the banks, where they go from creating a data risk management department as well as data audit departments. So that's how they are doing it. Data governance and data policies need to be in place, and IT architecture around the data governance, because the risk of too much of integrations with fintechs and all is the unintended exposure of the sensitive data. With the Digital Private Data Protection Act coming into India, the responsibility increases multiple fold. So we need to be very aware of what exactly to the extent our data is being exposed and what is the controls on the vendors. So vendor risk again becomes a major role, because as an agent your reputation is very much at risk and huge penalties being articulated in the act also. So that is, we cannot afford to ignore this data. So this data management has to be strategy of the institution. It should be the main strategy. As long as it doesn't set from the top, doesn't come. So banks are really not prepared. Everybody knows the importance and bits and pieces, silos approach people are using, but an integrated data and integrated data governance and risk management of data risk management, these are quite essential, and that should become, it is an emerging thing. Even in Singapore, institutions are recruiting people for data risk management. So 150 people team is sitting in some of the top developed banks. So that is the kind of structure we have to build in these institutions.
I really like the fact that, while the question was around data and analytics, your entire answer was around just data, because it is garbage in, garbage out, right? As long as the data is correct and it is a single source of truth, of course, we can play analytics on top of it. But I just have one follow-up question, since you talked so much about data management. Do you see DPDP as being a challenge, impediment, or you think it will further help us accelerate the journey of data management that you talked about?
It has to be. So it has to be taken in all spirit, because we cannot afford to expose the sensitive data. But the clauses of penalties and all, of course, it may undergo change. That's what we are looking at. But it is time that we should really take it seriously, and we should work on it. we should take it in full spirit.
Yeah, I think especially for banking ecosystem, it's going to be a nightmare to comply to it.
Big challenge.
Big challenge. I think another reason why CROs are losing sleep, in addition to cyber. So, Mr. Negi, coming back to you, I think there is also one more risk. That I think whenever we interact with CROs, we figure out compliance to regulations, right? How to interpret regulations and make sure that we are compliant, right? Is it really that ambiguous and difficult, or we are making too much, thinking too much and not acting enough to be able to be regulatory compliant? Where do we stand as an ecosystem?
I was just looking at for example, the penalties actually levied by the regulators around the world. Actually, so there's just analyzing whether you could have actually known about it or you could have prevented them, and the answer was yes. You could have actually prevented them. Now they can be like intentional or unintentional, but there again, I come back how actually you can help. Because the compliance is the job role of everybody in the organization, and the tone has to be set at the top. So the CEO, the board, and everybody else has to actually communicate that the compliance, the business cannot happen at the cost of the compliance, and compliance is very much integral part of it. So if all the top is very clear, the culture actually percolates down, then comes to the point that how you actually help people in their day-to-day compliances. And then again, we come back to the data-driven decisions, which Venkatesha was talking about. So today we have with the data analytics, you can actually detect the unusual patterns or the spikes in the graph, and then you can actually address them. And it is possible to do it on real-time basis. So we have those capabilities. For example, with us, we have set up the big data lake, and we have that IT structure in place. And for me to know about this data on the real-time basis, it's easier to get that sort of information and then act on that. So that is extremely important. But then again, as Sanmay was saying, are we actually trained enough? But then we come back to the capacity building, which are actually CGM RBI was talking about in the morning. This is a very, very critical area in all of us. Now we can't say, we can't stay to be a general banker, and we can't say that we know about AI on the top of it or the data analytics on top of it. Probably all of us need to go a little deeper and understand technology and probably use ourselves. And that is how the organization has to be trained. So we moved from the finance, it was a finance function, we moved to the fintech, and probably now the next stage is technology. So if we do not understand the technology, the AI, ML, how we are going to handle, and just see the guy who is entering into the system, the new joinee, the new people who come, they come with these skill sets. Now leaders sitting at the top, if they do not understand, there is going to be a gap, and therefore understanding is extremely important. Another area is now generative AI actually enables us. So we might find in future CRO.ai. So for example, I am CRO.hi, human intelligence, and there might be CRO.ai. So CRO.ai is helping me in my day-to-day functions. So it's very easy for the CRO.ai to actually go into the system, detect those patterns, and then let me know what are the risks in the organization which we are facing on day-to-day basis. So that is extremely important. Another important aspect is something which is not captured as part of the system. So some of the data points, some of the rumors, gossips, they might not find place in your system, but there might be answer in terms of market intelligence. So do we have that sort of market intelligence at the business level? What is happening at the ground level? Does it come to the CRO on day-to-day basis? Can I come to know about it? Whether it is true or not true, because it will have later on severe implications. So that might lead to us to the proactive risk management and compliance in a better way. So those are few thoughts.
Few and profound. I think the CRO.ai is a really good one. I think yet another use case to how we could leverage GenAI. So from my perspective, we'll just end with the last question, Sanmay, and slightly again a philosophical one. I think the complexity and volatility is at all-time high. We get it, and so are the tools. We talked about GenAI. We talked about many things. Which are data and analytics, which are aiding you to tackle with this volatility. And on top of it, there is a new workforce that is now entering the ecosystem, not just banking ecosystem in general, right? We read so much about Gen Z, and then just a couple of days back I was reading about Gen Alpha. I've not been able to understand Gen Z, and now there's Gen Alpha, right? So the things are changing, right? How do you think about attracting the right talent to something so boring as risk, and then grooming them and make it exciting for them to do something new in this?
Thanks, Abhinav. That's again another tough one. As you were saying, it is philosophical. As you were rightly pointing out, over the last 40 minutes or 50 minutes, we are talking about IT race, we are talking about analytics, we are talking about AI, and we have not even talked about what we generally all talk about, the boring stuff about credit risk, market risk, ALM. So basically, we are looking for a risk management department, which is a God department probably, who is supposed to do everything. And also, why not about compliance, as has been told just now, look into, and going forward, why not into MLTF? Why not into the entire AML compliance? So basically, then it becomes that a department whose hand has to be everywhere, and this is a very big change. If I look to last 10 years, the last decade, the change has been humongous, that what is required out of this department. And I understand even RBI has multiple times and continuously talking about capacity building coming out of that. And it is also, let us not delude ourselves, as we rightly pointing it out, risk management is considered a boring. Banking itself is boring. Risk management is the boringest of the boring part of the banking in that sense. What do you do? But there are some silver lines. If you think about that, some of these newer areas are actually exciting. If you think about data analytics, and if you think about the kind of opportunities that is there, if you look to the data analytics which was done in a typical risk management department, at least in this country, 5 to 10 years back, was just looking to the customer data. I'm talking retail side. Look to the customer data, see how the create a logistic regression kind of approach, and try to see whether you do a go no go on that. Today you have a much richer set of data. The amount of data which is available to anybody to create a model is quantitatively larger and more richer, which means that one can, if I am a person who is just coming out of the university, I shall be actually salivating, thinking about what I can do out here right now. And today is another time when, given the cheapening of the computer resources, the amount of new types of techniques which is coming up, changing the entire paradigm of what was done 10 years back versus today in analytics is possible today. So that is one area where I am seeing many of the youngsters do get quite enthused. Is that enough? No, it is not enough. Especially if I talk about newer areas, one of the trouble I see is that if you go to the market, if you don't talk about Gen Z, talk about the Gen X, even for the Gen X. If you go to the market and you want to hire a credit risk person, easier. They know what is a credit risk analyst means, what is the career path of a credit risk analyst. So it is something one can understand. A market risk analyst, yes, it is understandable. IT risk, what is an IT risk? Half of them will question you back, saying that what do you mean? And it will be another half an hour to explain to them that what we are talking about. You go into more esoteric area, it becomes even more questionable that who want to come. My own feeling is that given these challenges, there are only two ways to handle that. One is that you do, or rather all of us do, lateral hiring within the organization. That is probably the easiest and the best, and that way we also, the business gains risk expertise, risk gets business expertise. That is the extra benefit that gets, especially in the newer areas where there is no strong risk culture built over the decades. So that helps. Second one is that to catch them young, catch them in the university, and do a very strong in-house training over the years and build it up over the next few years to make sure they understand. That also will leave out one large part, which I think Mr. Negi was talking in answer to the first question, interconnectedness. Even then you will end up creating silos. So maybe there are two different levels. One is that the youngsters are coming out, maybe a little silo, maybe a little bit of specialization in some areas. Then you come to a certain middle level and then you encourage them to move within risk management between departments. Maybe a credit risk manager doesn't know anything about market risk, but let them be there. They will understand that derivative also have a credit risk. Otherwise, it is a little theoretical for them to understand. So maybe these 3-4 different strategies, one strategy will not work. 3-4 might work. Will there be a problem? We shall continue to say that there is a problem, but at least we shall be going somewhere.
Yeah, fair point. And I think, as you rightly said, we have to try. We don't know what will work, but yeah, these are some good initial thoughts to just think about it.
Just adding one point to what Sanmay said actually. And now a lot of demand actually on the risk management function, as Sanmay rightly said. Are you supposed to look into KYC, ML, audit, and other things? But if you see the regulatory language, actually they have been encouraging us to collaborate. I mean, probably all the functions, the 3 lines of defense, they need to come together and share the information, and then that information you can receive and you can digest, and accordingly you can actually work in a more of a collaborative approach. And second, which you said, the capacity building is extremely important, and I can just narrate one of the. So we were about to build models. Our model building team actually develops model in the programming language, or they build some model based on the decision tree, and then I am supposed to explain that to the board. So my model builder team cannot go to the board to explain. It's the CRO only who will explain. And the way now even the boards have become smarter, they pose very technical questions. And then you need to understand. So that is why I said, at our level also, at a cross level, we should have some kind of like deep understanding, not as kind of shallow understanding, but a deep understanding of things where we can actually explain it well, and we can actually fill the gap between the young generation and the top in terms of knowledge.
Thank you.
Yep. So thank you so much. Thank you, everyone. We have a minute or two for any questions from the audience before we close for the day. Please.
One word, yes.
I mean, me or the panel? Of course. Please, yeah. All part of it.
One word, yes or no answer. Do you think current equity markets adequately discount the level of geopolitical risk in the world at the moment?
You can take anything, yes or no.
It's a dangerous question. The answer is no. And I'm luckily not the CRO, so I'm happy to say it.
Related. I mean, I'm saying in relative terms, I think, but at the same time, it was more around factoring the future prospect, future growth. That is the way you can correlate the stock market movement. But of course, you would have seen a different trajectory today. That's a different trajectory altogether.
Abhinav?
Equity has always been a risk. Volatility has to be its nature. We have to accept it.
Yeah.
May I ask a question?
Any other questions? Yeah, please. Yeah.
What a fantastic discussion. I was gripped by risk management like never before. My question is this, that the entire discussion, Abhinav, that you so wonderfully moderated, and everybody had such, intrinsic and deep insight. I spoke on the climate panel in the morning, and I said that I just have to introduce the word climate, and almost everything that you said is equally true for climate risk plus climate business and climate finance. So my question is this, that where do the CROs, as well as even the business function within the banks, find those key differences between traditional risk and climate risk and opportunities, that it is making them a little bit hesitant, if I could use that word, to really integrate it and to really be proactive within organizations on this?
If I may start, and Mr. Rao may have a more insightful knowledge on that. My answer will be in one or two lines. See, the biggest worry we get, or at least I get, is that I do not have a proper data, which means I cannot make a a priori decision that what kind of risk I am running today. That is something which gives me a lot of pause as far as climate is concerned. It is a risk where I do not know the dimension of. That, if I may say in a word, will be my, one sentence will be mine, but Mr. Rao or anybody else can.
No, I think I will only go by what I said earlier. We are on a journey. Uh, I don't think we have reached even a kind of perfection or even a satisfactory level with regard to measurement itself. And without even reaching a maturity level in measurement, understanding what portfolio is at risk, it's very difficult to strategize and come out in terms of what will be our approach to funding or what will be our approach to pricing. But to your other question around the awareness, I think this is a universal challenge everywhere, whether it is a climate risk or any other risk. I think it's a continuous agenda. Risk awareness is a continuous agenda. As people, there is a churn at the frontline level also. So is the case with climate risk. So we within the bank conduct a lot of awareness workshops for bringing awareness about the climate risk and the impending dangers, etc. Introduce them to taxonomy in climate risk, get the experts from the field. Actually, we did a lot of workshops, but I don't think, entire 100% is sensitive or aware. So it's we adopted a graded approach. First, tackle the relationship managers who are sourcing the business. So at least they can start engaging with the corporates, getting more data, or understanding the client's plans in terms of how do they want to make their operations more green. So it's simply a journey.
I may add to the Neha's point actually, which she was raising. So in our bank actually, so what we have done in risk management, we have set up a different cell within the risk management department. And now we are working on the entire policy framework as far as the climate risk management is concerned. So ESG is a separate vertical, but within E part of it, the climate risk management lies within the risk management, which reports to CRO. So it is work in progress, but on the side of like the last time RBI brought out this guideline on the green deposits. So we have launched those green deposits, you will see. And then on the financing side, the 9 sectors which RBI has given as part of the taxonomy. So there again, we track our book, both sides. So there's actually which goes into the balance sheet. But as far as the approach is concerned, the entire framework has to be developed, the expertise has to be there. So there is still the templates which you do as part of the credit risk evaluation. So anytime any project finance you're doing and you are evaluating the climate risk, the template has to be different for the construction, for cement, for steel. So that is still work in progress. So as Mr. Rao said and Sanmay said, it's actually beginning only, I can say.
One more question at the back.
Yeah. So I like what you said, Abhinav, earlier about a question being more bordering on the philosophical. So, and I'll build on the point that Sanmay made. You said that the difficulty comes in when the risk is non-quantifiable, right? And we all know that. And then as you talk about that, there is so much of discussion around data or lack of it. So my question to the panel is that as risk managers, have we become so focused on taking all decisions that are heuristically established that we have lost the touch to make decisions from the gut, as we call it?
I like this question very much, to be honest, because you say something very important, and that is indeed one of the things. If you define one of the core qualities of every banker, not only from the risk function, as having a feeling for risk and opportunity, because that's what you judge, certainly. If you take that, then one of the concerns that we sometimes have is that the gut feeling of the banker has been regulated out of it by the compliance function. So you tick the box and you're safe, but that's paper reality. So what we try to get in, and indeed the earlier question on climate risk is an important one, because the dimension is big and it is different to quantify, exactly as you say. That means that we need to get back and in a bank trust more to the gut feeling of where risk lies. And it is true that the balance between ticking the box approach and trying to do fully rule-based takes away the actually unique talent of a good risk manager.
Okay. Thank you so much for being a lovely audience, and thank you so much to all the panelists for being patient.
Thank you.
Thank you.
Thank you all dignitaries. May I request all dignitaries on the dais to stay back for a group photograph, please. Ladies and gentlemen, we will take 5 minutes to reset the dais before we move on to the final session of the day, valedictory address by Mr. T. Ravi Shankar, Deputy Governor, RBI.